Toolkit, Japanese Candlestick Charts. Japanese Candlestick Charting Techniques by Steve Nison. Steve Nison's Japanese Candlestick Charting Techniques is widely regarded as the definitive guide to candlestick charting, often referred to as the Bible of candlestick analysis. As the person who introduced Japanese candlesticks to the Western world, Nison provides an in-depth, structured approach to understanding this powerful charting method. Key takeaways. Comprehensive coverage. The book covers all aspects of candlestick charts, from basic patterns like doji, hammer, and engulfing, to more complex formations and strategies. Historical and cultural context. Nison delves into the origins of candlestick charting in 17th century Japan, explaining how rice traders developed these techniques. Integration with Western analysis. The book does an excellent job of combining candlestick techniques with traditional Western indicators such as moving averages, trend lines, and oscillators. Practical applications. Nison provides real-world examples and case studies, demonstrating how traders can use candlesticks to make better trading decisions. Strong educational value. The book is structured for both beginners and experienced traders, making complex concepts accessible while still offering depth for advanced learners. Strengths. Well-explained concepts. Nison presents the material in a clear and methodical way. Versatile application, useful for stocks, forex, commodities, and other financial instruments. Timeless strategies. Candlestick patterns remain highly relevant in today's markets. Weaknesses. Dated charts. Some chart examples feel outdated compared to modern trading platforms. No algorithmic trading focus. The book doesn't cover how candlestick patterns can be used in automated or algorithmic trading. Final verdict. Japanese Candlestick Charting Techniques is essential reading for any serious trader. Whether you're new to trading or an experienced investor looking to refine your skills, this book offers invaluable insights into market psychology and price action.
Japanese Candlestick Charting Techniques by Steve Nison. Chapter 1, Introduction. The beginning is most important. Japanese candlestick chart analysis, so called because the lines resemble candlesticks, has been refined by generations of use in the Far East. Until the publication of Japanese Candlestick Charting Techniques, the claws of Japanese charting analysis, that is, candle charts, were a hidden secret from the Western world for over a century. That book revealed in detail, for the first time to the Western Hemisphere, these secrets of the Orient. Since the term candlesticks is often shortened to candles, I will use both terms interchangeably throughout this book. I am flattered that my work has been credited with revolutionizing technical analysis, and that all subsequent books, articles, etc. by other authors have used the first edition of this book as their underpinning. This is what I had hoped. The premise of that book was to lay the foundation for future candle charting material. It is thus very gratifying to have this book often called the Bible of candle charting. Before the publication of this book in 1991 BC, before candlesticks, who ever heard of a candlestick chart? Now, who hasn't? Online traders, day traders, institutional propriety traders, and market makers are just some of the candle charting enthusiasts. Websites, real-time trading systems, and technical analysis software packages include candle charts. This attests to the popularity and universal appeal candles have to trading today's volatile markets. Candles are hotter than ever. My 11-year-old son, Evan, who was almost called Candlesticks Nison when he was born, saw an online charting service that had candle charts. He said, "Daddy, so if it wasn't for you, there would be no candle charts on the web or anywhere in America. Is that right?" I said that was true. He hesitated and then said, "Cool. I want to raise in my allowance." What's new in this book? While the format and underlying concepts are the same as the first edition, if it ain't broke, don't fix it, the trading environment and players in the market have changed since that edition. Consequently, besides having all new charts, this edition has more intraday markets, more focus on active trading for swing, online, and day traders, new tactics for getting maximum use from intraday charts, new Western techniques in combination with candles, a greater focus on capital preservation. Why have candle charting techniques captured the attention of traders and investors around the world? Year after year, the flames of interest grow ever brighter for these charting tools. This is because candle charts are easy to understand. Anyone, from the first-time chartist to the seasoned professional, can easily harness the power of candle charts. Don't let the simplicity of these tools fool you. Their power to analyze the health of the market is unmatched by any other charting methodology. Provide earlier indications of market turns. Candle charts often send out reversal signals well before those of traditional indicators on bar or point and figure charts. This should help you to enter and exit the market with better timing. Furnish unique market insights. Candle charts not only show the trend of the move, as does a bar chart, but unlike bar charts, candle charts also show the force underpinning the move, are enjoyable to learn. The picturesque terms such as dark cloud covers, hammers, and windows make candle charts fun to use. But don't let the picturesque names fool you. These techniques will be potent weapons in your battle with the markets. Enhance Western charting analysis. Candle charts are so versatile, they can be fused with any Western technical tool. For our clients, we merge the insights given by the candle charts with the most potent Western technical analysis tools. If you are a seasoned technician, you will discover how joining Japanese candles with your favorite technical tools can create a powerful synergy of techniques. This merging of Eastern and Western analysis will give you a jump on those who use only traditional Western charting techniques. Will increase efficiency of your analysis. Because of the immediate visual information sent out by the candle charts, they will make your market analysis faster and more efficient. As the Oriental proverb states, the journey of 1,000 miles begins with the first step. This chapter is that first step, albeit an important one, on the road to candle chart analysis. Yet, even after this introductory chapter, you will discover how the candles will help make your market analysis more efficient, improve entry and exit timing, and open new, effective, and unique avenues of analysis. I made a bold forecast in the first edition of this book. I said, in the near future, candle charts may become as standard as the bar chart. As more technical analysts become comfortable with candle charts, they will no longer use bar charts. This, indeed, is what is unfolding. At the conclusion of my institutional and public seminars, I often ask the audience, how many of you will now use bar charts? Of the thousands of traders who have taken my seminars, no one has ever raised a hand. If you are new to candles, you will understand why after reading this book, or even the first few chapters. Using candle charts instead of bar charts is a win-win situation. As we will see in the chapter on drawing candle lines, the same data is required to draw the candle charts as for the bar charts: open, high, low, and close. This is very significant. It means that any of the technical analyses used with bar charts, such as moving averages, trend lines, retracements, etc., can be employed with candle charts. But, and this is the key point, candle charts can send signals not available with bar charts. This aspect will give you a jump on those who use only traditional Western charting techniques. By employing candle charts instead of bar charts, you have the ability to use all the same analyses as you could use with bar charts. But candle charts send out insights into the health of the market that are unavailable anywhere else. Who is this book for? This book is for you if your charting service has candle charts and you want to unlock their full potential. You want to get a jump on the competition. You would like to enter and exit the market with better timing. You want added value techniques to complement trading tools you now use. You want to have fun while you learn. You are new to candle charts or are a seasoned pro, some background. Why, I have often asked myself, has a system that has been around so long been almost completely unknown in the West? Were the Japanese trying to keep it secret? I don't know the answer to this, but it took years of research to fit all the pieces together. I was fortunate in several ways. Perhaps my perseverance and serendipity were the unique combination needed that others did not have. I became acquainted with a Japanese broker in 1987. One day, while I was with her in her office, she was looking at one of her Japanese stock chart books. Japanese chart books are in candle form. She exclaimed, "Look, a window." I asked what she was talking about. She told me a window was the same as a gap in Western technicals. She went on to explain that while Western technicians use the expression filling in the gap, the Japanese would say closing the window. She then used other expressions like doji and dark cloud cover. I was hooked. I spent the next 3 years exploring, researching, and analyzing anything I could about candle charts. It was not easy. My initial education was with the help of a Japanese broker and through drawing and analyzing candle charts on my own. Then, thanks to the Market Technicians Association, MTA, library in New York City, I came across a booklet published by the Nippon Technical Analysts Association called Analysis of Stock Price in Japan. It was a Japanese booklet that had been translated into English. Unfortunately, there were just 10 pages on interpreting candle charts. Nonetheless, I finally had some English candle material. A few months later, I borrowed a book that provided some more basic candle charting information. Once again, I had found it at the MTA library. The MTA office manager, Shelley Libek, brought a book back from Japan entitled The Japanese Chart of Charts by Seiki Shimizu and translated by Greg Nicholson, published by the Tokyo Futures Trading Publishing Co. It was an important find since it contained about 70 pages on candle charts and was written in English. As I discovered, while the book yielded a harvest of information, it took some effort and time to get comfortable with its concepts. They were all so new. I also had to become comfortable with the Japanese terminology. The writing style was sometimes obscure. Part of this might have to do with the difficulty of translation. The book was originally written in Japanese about 25 years ago for a Japanese audience. I also found out when I had my own material translated that it is dreadfully difficult to translate such a specialized subject from Japanese to English. Nonetheless, I had some written reference material. I carried the book with me for months, reading and rereading, taking copious notes, applying the candle methods to the scores of my hand-drawn candle charts. Since there wasn't any candle charting software, all my charts had to be constructed by hand. I chewed and grinded away at the new ideas and terminology. I was fortunate in another way. I had the help of the author, Seiki Shimizu, to answer my many questions. Although Mr. Shimizu does not speak English, the translator of the book, Greg Nicholson, graciously acted as our intermediary via fax messages. The Japanese chart of charts provided a base for the rest of my investigation into candles. In order to expand my nascent abilities in candle charting techniques, I sought out Japanese candle practitioners who would have the time and inclination to speak with me about the subject. I met a Japanese trader, Morihiko Goto, who had been using candle charts and who was willing to share his valuable time and insights. This was exciting enough. Then he told me that his family had been using candle charts for generations. We spent many hours discussing the history and the uses of candle charts. He was an invaluable storehouse of knowledge. My real treasure trove of information is the Japanese candle charting literature that I had translated. For this, I had the extreme good fortune to find a translator, Richard Solberg. His ability to track down all the candle charting books in Japan. To my knowledge, I have the largest collection outside Japan, and his translating skills were invaluable. In December 1989, I authored a 2-page article on candle charts. This was the first information on the subject ever written by a non-Japanese. In early 1990, as my thesis for the Chartered Market Technician exam for the MTA, I wrote a paper on candle charts. This was the first detailed article ever authored by an Occidental about Japanese candle charts. A pamphlet at Merrill Lynch, which had over 10,000 requests, soon followed. Japanese Candlestick Charting Techniques was published in 1991, followed in 1994 by Beyond Candlesticks, John Wiley. As of this writing, these books have been translated into 8 languages and have gone through many printings. My work has been highlighted in financial media around the world, including the Wall Street Journal, the Japan Economic Journal, Barron's, Worth Magazine, Institutional Investor, and scores of other publications. An appearance on FNN, the predecessor to CNBC, drew the largest audience that station ever had. I've had the privilege of revealing my trading strategies to thousands of traders and analysts in over 17 countries, including, of all places, Hanoi, Vietnam. I also had the honor of speaking before the World Bank and the Federal Reserve. I founded Nison Research International in 1997 to provide institutional on-site customized seminars and analytical services. I formed CandleCharts.com in 2000, which offers web-based seminars, videos, and other services. I invite you to visit our site at www.candlecharts.com. What is in this book? In the first part of the book, you'll learn how to draw and interpret scores of candle lines and formations. This will slowly and clearly lay a solid foundation for part 2, where you will discover the value of integrating candles with Western technical techniques. My goal is not to give you market omniscience. My hope is that the ideas in this book will show how Japanese candles can enlighten your trading. The best way to explain how an indicator works is through marketplace examples. The Japanese say, "One seeing is better than 100 hearings." Therefore, there will be numerous real-world examples of each technique. My focus will be mainly on the US markets, but the tools and techniques in this book are applicable to any market and time frame. This is attested by the fact that candle charts are used on weekly for hedgers, daily for swing and intermediate term traders, and intraday charts for swing and day traders. The tactics addressed in this book can be used for equities, futures, options, foreign exchange, anywhere and in any time frame in which technical analysis is applied. I have drawn illustrations of candle patterns to assist in the educational process. These illustrations are representative examples only. The drawn exhibits should be viewed in the context that they show certain guidelines and principles. The actual patterns do not have to look exactly as they do in the exhibits in order to provide you with a valid signal. This is emphasized throughout the book in the many chart examples. You will see how variations of the patterns can still provide important clues about the state of the markets. Thus, there is some subjectivity in deciding whether a certain candle formation meets the guidelines for that particular formation. But this subjectivity is no different from that with other charting techniques. For instance, if a stock has support at $100, is support considered broken if prices go under $100 intraday? Or do prices have to close under $100? Does a 50-cent penetration of $100 substantiate broken support? Or is a larger penetration needed? You will have to decide these answers based on your trading temperament, your risk adversity, and your market philosophy. Likewise, through text, illustrations, and real-world examples, I will provide the general principles and guidelines for recognizing the candle formations. But you should not expect the real-world examples to always match their ideal formations. 2 glossaries are at the end of the book. The first includes candle terms, and the second, Western technical terms used in the book. The candle glossary includes a visual glossary of all the patterns. Some cautions. As with any subjective form of technical analysis, there are at times variable definitions that will be defined according to the user's experience and background. This is true of some candle patterns. Depending on my source of information, there were instances in which I came across different, albeit usually minor, definitions of what constitutes a certain pattern. For example, one Japanese author writes that the open has to be above the prior close in order to complete a dark cloud cover pattern. Other written and oral sources say that, for this pattern, the open should be above the prior high. In cases where there were different definitions, I chose the rules that increased the probability that the pattern's forecast would be correct. For example, the pattern referred to in the prior paragraph is a reversal signal that appears at tops. Thus, I chose the definition that the market should open above the prior day's high. This is because it is potentially more bearish if the market opens above the prior day's high and then fails, versus if the market opens above the prior day's close and then failed. Much of the Japanese material I had translated is less than specific. Part of this might be the result of the Japanese penchant for being vague. The penchant may have its origins in the feudal ages when it was acceptable for a samurai to behead any commoner who did not treat him as expected. The commoner did not always know how a samurai expected him to act or to answer. By being vague, many heads were spared. However, I think the more important reason for the somewhat ambiguous explanations has to do with the fact that technical analysis is more of an art than a science. One should not expect rigid rules. Most forms of technical analysis are guideposts. For instance, if one of the Japanese books says that a candle line has to be surpassed to forecast the next bull move, I equate surpassed with on a close above. That is because, to me, a close is more important than an intraday move above resistance or below support. This is another example of subjectivity. In the Japanese literature, many candle patterns are described as important at a high price area or at a low price area. Obviously, what constitutes a high price or low price area is open to interpretation. One of the techniques I suggest using to gauge low or high price is an oscillator to see if the market is oversold or overbought. This is an example of why it is valuable to add classic Western technical tools, such as oscillators, to those of candle charts. Before I delve into the topic of candle charts, I will briefly discuss the importance of technical analysis as a separate discipline. For those of you who are new to this topic, the following section is meant to emphasize why technical analysis is so important. It is not an in-depth discussion. If you are already familiar with the benefits of technical analysis, you can skip this section. Do not worry if you do not read the following section. It will not interfere with later candle chart analysis information. The importance of technical analysis. The importance of technical analysis is multifaceted. First, while fundamental analysis may provide a gauge of the supply-demand situations, i.e. price-earnings ratios, economic statistics, and so forth, there is no psychological component involved in such analysis. Yet the markets are influenced at times, to a major extent, by emotionalism. As John Maynard Keynes stated, there is nothing so disastrous as a rational investment policy in an irrational world. Technical analysis provides the only mechanism to measure the irrational, emotional component present in all markets. Here is an entertaining story about how strongly psychology can affect a market. It is from the book, The New Gatsbys. It takes place at the Chicago Board of Trade. Soybeans were sharply higher. There was a drought in the Illinois soybean belt. And unless it ended soon, there would be a severe shortage of beans. Suddenly, a few drops of water slid down a window. "Look!" someone shouted. "Rain!" More than 500 pairs of eyes, the traders, shifted to the big windows. Then came a steady trickle, which turned into a steady downpour. It was raining in downtown Chicago. Sell. Buy. Buy. Sell. The shouts cascaded from the traders' lips with a roar that matched the thunder outside. And the price of soybeans began to slowly move down. Then the price of soybeans broke like some tropic fever. It was pouring in Chicago, all right, but no one grows soybeans in Chicago. In the heart of the soybean belt, some 300 miles south of Chicago, the sky was blue, sunny, and very dry. But even if it wasn't raining on the soybean fields, it was in the heads of the traders, and that is all that counts. To the market, nothing matters unless the market reacts to it. The game is played with the mind and the emotions. In order to drive home the point about the importance of mass psychology, think about what happens when you exchange a piece of paper called money for some item like food or clothing. Why is that paper, with no intrinsic value, exchanged for something tangible? It is because of a shared psychology. Everyone believes it will be accepted, so it is. Once this shared psychology evaporates, when people stop believing in money, it becomes worthless. Second, technicals are also an important component of disciplined trading. Discipline helps mitigate the nemesis of all traders, namely emotion. As soon as you have money in the market, emotionalism is in the driver's seat and rationale and objectivity are merely passengers. If you doubt this, try paper trading. Then try trading with your own funds. You will soon discover how deeply the counterproductive aspects of tension, anticipation, and anxiety alter the way you trade and view the markets, usually in proportion to the funds committed. Technicals can put objectivity back into the driver's seat. They provide a mechanism to set entry and exit points, to set risk-reward ratios, or stop-out levels. By using them, you foster a risk and money management approach to trading. As touched upon in the previous discussion, the technicals contribute to market objectivity. It is human nature to see the market as we want to see it, not as it really is. How often does the following occur? A trader buys. Immediately, the market falls. Does he take a loss? Usually no. Although there is no room for hope in the market, the trader will glean all the fundamentally bullish news he can in order to buoy his hope that the market will turn in his direction. As one of our advisory clients put it, you root for your position. Meanwhile, prices continue to descend. Perhaps the market is trying to tell him something. The markets communicate with us. We can monitor these messages by using the technicals. This trader is closing his eyes and ears to the messages being sent by the market. If this trader stepped back and objectively viewed the price activity, he might get a better feel of the market. What if a supposedly bullish story is released and prices do not move up or even fall? That type of price action is sending out volumes of information about the psychology of the market and how one should trade in it. I believe it was the famous trader Jesse Livermore who expressed the idea that one can see the whole better when one sees it from a distance. Technicals make us step back and get a different and perhaps better perspective on the market. Third, following the technicals is important even if you do not fully believe in their use. This is because, at times, the chart actions are the major reason for a market move. Since they are a market-moving factor, they should be watched. Fourth, random walk proffers that the market price for one day has no bearing on the price the following day. But this academic view leaves out an important component: people. People remember prices from one day to the next and act accordingly. To wit, people's reactions indeed affect price, but price also affects people's reactions. Thus, price itself is an important component in market analysis. Those who disparage technical analysis forget this last point. Fifth, the price action is the most direct and easily accessible method of seeing overall supply-demand relationships. There may be fundamental news not known to the general public, but you can expect it is already in the price. Those who have advanced knowledge of some market-moving event will most likely buy or sell until current prices reflect their information. End of Chapter 1. Chapter 2, a historical background. Through inquiring of the old, we learn the new. This chapter provides the framework through which Japanese technical analysis evolved. For those who are in a rush to get to the meat of the book, that is, the techniques and uses of candlesticks, you can skip this chapter or return to it after you have completed the rest of the book. It is an intriguing history. Among the first and the most famous people in Japan to use past prices to predict future price movements was the legendary Munehisa Homa. He amassed a huge fortune trading in the rice market during the 1700s. Before I discuss Homa, however, I want to provide an overview of the economic background in which Homa was able to flourish. The time span of this overview is from the late 1500s to the mid-1700s. During this era, Japan went from 60 provinces to a unified country where commerce blossomed. From 1500 to 1600, Japan was a country incessantly at war, as each of the daimyo, literally big name, meaning a feudal lord, sought to wrestle control of neighboring territories. This 100-year span between 1500 and 1600 is referred to as Sengoku Jidai, or literally, Age of Country at War. It was a time of disorder. By the early 1600s, three extraordinary generals, Nobunaga Oda, Hideyoshi Toyotomi, and Ieyasu Tokugawa, had unified Japan over a 40-year period. Their prowess and achievements are celebrated in Japanese history and folklore. There is a Japanese saying, "Nobunaga piled the rice, Hideyoshi kneaded the dough, and Tokugawa ate the cake." In other words, all three generals contributed to Japan's unification, but Tokugawa, the last of these great generals, became the shogun whose family ruled Japan from 1615 to 1867. This era is referred to as the Tokugawa shogunate. The military conditions that suffused Japan for centuries became an integral part of candlestick terminology. If you think about it, trading requires many of the same skills needed to win a battle. Such skills include strategy, psychology, competition, strategic withdrawals, and yes, even luck. So it is not surprising that throughout this book, you will come across candlestick terms that are based on battlefield analogies. There are night and morning attacks, the advancing three soldiers pattern, counterattack lines, the gravestone, and so on. The relative stability engendered by the centralized Japanese feudal system led by Tokugawa offered new opportunities. The agrarian economy grew, but more important, there was expansion and ease in domestic trade. By the 17th century, a national market had evolved to replace the system of local and isolated markets. This concept of a centralized marketplace was to lead indirectly to the development of technical analysis in Japan. Hideyoshi Toyotomi regarded Osaka as Japan's capital and encouraged its growth as a commercial center. Osaka's easy access to the sea, at a time where land travel was slow, dangerous, and costly, made it a national depot for assembling and dispersing supplies. It evolved into Japan's greatest city of commerce and finance. Its wealth and vast storehouses of supplies provided Osaka with the appellation the Kitchen of Japan. Osaka contributed much to price stability by smoothing out regional differences in supply. In Osaka, life was permeated by the desire for profit, as opposed to other cities in which money-making was despised. The social system at that time was composed of 4 classes. In descending order, they were the soldier, the farmer, the artisan, and the merchant. It took until the 1700s for merchants to break down the social barrier. Even today, the traditional greeting in Osaka is mokaramaka, which means, "Are you making a profit?" In Osaka, Yodoya Keion became a war merchant for Hideyoshi, one of the 3 great military unifiers. Yodoya had extraordinary abilities in transporting, distributing, and setting the price of rice. Yodoya's front yard became so important that the first rice exchange developed there. He became very wealthy, as it turned out too wealthy. The Bakufu, the military government led by the shogun, confiscated his entire fortune in 1705 on the charge that he was living in luxury, not befitting his social rank. The Bakufu was apprehensive about the increasing amount of power acquired by certain merchants. Certain officials and merchants tried to corner the rice market in 1642. The punishment was severe. Their children were executed, the merchants were exiled, and their wealth was confiscated. The rice market that originally developed in Yodoya's yard was institutionalized when the Dojima rice exchange set up in the late 1600s in Osaka. The merchants at the exchange graded the rice and bargained to set its price. Up until 1710, the exchange dealt in actual rice. After 1710, the rice exchange began to issue and accept rice warehouse receipts. These warehouse receipts were called rice coupons. These rice receipts became the first futures contracts ever traded. Rice brokerage became the foundation of Osaka's prosperity. There were more than 1,300 rice dealers. Since there was no currency standard, the prior attempts at hard currency failed due to the debasing of the coins. Rice became the de facto medium of exchange. A daimyo needing money would send his surplus rice to Osaka, where it would be placed in a warehouse in his name. He would be given a coupon as a receipt for this rice. He could sell this rice coupon whenever he pleased. Given the financial problems of many daimyos, they would also often sell rice coupons against their next rice tax delivery. Taxes to the daimyo were paid in rice, usually 40 to 60% of the rice farmer's crop. Sometimes the rice crop of several years hence was mortgaged. These rice coupons were actively traded. The rice coupons sold against future rice deliveries became the world's first futures contracts. The Dojima Rice Exchange, where these coupons traded, became the world's first futures exchange. Rice coupons were also called empty rice coupons, that is, rice that was not in physical possession. To give you an idea of the popularity of rice futures trading, consider this. In 1749, there were a total of 110,000 bales, rice used to trade in bales, of empty rice coupons traded in Osaka. Yet, throughout all of Japan, there were only 30,000 bales of rice. Into this background steps Homa, called God of the Markets. Munehisa Homa was born in 1724 into a wealthy family. The Homa family was considered so wealthy that there was a saying at that time, "I will never become a Homa, but I would settle to be a local lord." When Homa was given control of his family business in 1750, he began trading at his local rice exchange in the port city of Sakata. Sakata was a collections and distribution area for rice. Since Homa came from Sakata, you will frequently come across the expression Sakata's rules in Japanese candlestick literature. These refer to Homa. When Munehisa Homa's father died, Munehisa was placed in charge of managing the family's assets. This was in spite of the fact that he was the youngest son. It was usually the eldest son who inherited the power during that era. This was probably because of Munehisa's market savvy. With this money, Hama went to Japan's largest rice exchange, the Dojima Rice Exchange in Osaka, and began trading rice futures. Hama's family had a huge rice farming estate. Their power meant that information about the rice market was usually available to them. In addition, Hama kept records of yearly weather conditions. In order to learn about the psychology of investors, Hama analyzed rice prices going back to the time when the rice exchange was in Yodoya's yard. Hama also set up his own communications system. At prearranged times, he placed men on rooftops to send signals by flags. These men stretched the distance from Osaka to Sakata. After dominating the Osaka markets, Hama went to trade in the regional exchange at Edo, now called Tokyo. He used his insights to amass a huge fortune. It was said he had 100 consecutive winning trades. His prestige was such that there was the following folk song from Edo. When it is sunny in Sakata, Hama's town, it is cloudy in Dojima, the Dojima Rice Exchange in Osaka, and rainy at Kurame, the Kurame Exchange in Edo. In other words, when there is a good rice crop in Sakata, rice prices fall on the Dojima Rice Exchange and collapse in Edo. This song reflects Hama's sway over the rice market. In later years, Hama became a financial consultant to the government and was given the honored title of samurai. He died in 1803. Hama's books about the markets, Sakata Senho and Sobasani no Den, were said to have been written in the 1700s. His trading principles, as applied to the rice markets, evolved into the candlestick methodology currently used in Japan. End of chapter 2.